So this video is to answer a simple question. What will be the expected change in your portfolio value if Fed were to increase interest rates by 0.25%? This is based on earnings yield, and we basically develop upon that theory. And we will use the portfolio that we created in the past weeks. It's a $100,000 portfolio with a beta of 1. A portfolio that includes your chosen company and any other 4 or 5 companies with an ETF. Now, for the purposes of this assignment, you can take the ETF out simply because ETF will not have a PE value. And I try to choose companies that have positive earnings per share. And they may not be that easy to find because of the coronavirus financial crisis. But for the sake of this lecture, it's just easier for me to explain it with the earnings per share. And while you're learning this, it may also be easier for you if you were to go with companies that have positive earnings per share. So I put together a little bit of portfolio, and like I said, no particular reason why I chose these companies, simply because they actually had positive EPS, and it's just easier to explain it this way. I wrote down their stock prices as of Friday's closing, market closing, and I also found their betas from Yahoo Finance. So this is, for instance, JP Morgan Chase, and the beta under summary right here, it is 114. So JPM right there, 114. So now what I will do is I will create a portfolio with random weights. I will try to make it as equal as possible. Again, other than an OCD, it really has no particular reason why I'm going with these values. But if I were to have 100 shares, then this would be the value. Now, Bank of America is $24, so I need somewhere around 400 shares, maybe 500 shares to have approximately that value. Similarly for AT&T, and then Exxon probably will be about 400. And then JP Morgan Chase about 100, although it's not really equal, but we'll get there. So for Walmart, let's go with 100 shares. Now, the total portfolio value is the addition of all of these. So we have about $75,000. So we have a little bit of a bigger room, about $25,000 to increase the value based on what our portfolio beta is right now. So the portfolio for each beta, the weighted beta will be your investment divided by the total times the beta in that investment. So for Apple, for instance, the weighted beta is 0.21. I'm going to fix D11 and then just copy this down. And we're going to add this up to see what our current, we are actually pretty close. So let's increase this a little bit so that we would have the intended $100,000. So first of all, let's go with Apple and increase that to about $14,000. Maybe this would be 550. And then this is a little bit low, so let's go with 150. And then this would be, well, we are approximately there. Now, first of all, we need to have this down to 1.0. So I need to increase the investment amount in stocks that have betas that are less than 1. So this AT&T has 0.67 and Walmart has 0.40. So if I were to increase the investment level in those companies, it should actually take my beta down to 1. So let's go with 150 of, that's actually quite nice. So that was rather easy, but we're still at 93,000. So let's increase JPM a little bit, say 170. We are at 95, but our beta is increased. So let's make this about 425, maybe 450. And let's make this 170. And we're close enough. So let's not try to be the perfectionist. So let's go with a $99,000 of a portfolio with a portfolio beta of exactly 1. So Now, the impact of interest rates on our portfolio value. But for that, we need the earnings per share. So let's go with Apple first. Let's see what the earnings per share is. Well, we have JP Morgan Chase actually pulled up. So the earnings per share is right here. That's 767. 767. Now let's do the same with Apple. The earnings per share is 328. And by the way, I'm going to use TradingView. Simply, it's just a bit faster. Bank of America, if you click right here on the watch list, the earnings per share is right there. It's 203. And then do the same for AT&T. Earnings per share is 153. And then Exxon, earnings per share is 78 cents. And then Walmart, the earnings per share is 631. Now, the most common ratio that, we actually had this in multiple videos, the PE, that's price to earnings, right? Price to earnings. However, what I like to do, a little bit more recent research on this, I'll swap this and I'll go from earnings to price. Right? So that's your earnings yield. So if we go with earnings to price, that's your earnings divided by the price, and that's a percentage. So basically says that based on that earnings per share, your net yield or earnings yield, so let's label this, earnings yield is 2.76%. Now, the Bank of America, right, very similarly. So this is your average earnings to price. Now, if you look at the earnings per share, and if we actually add them up, then you have earnings per share for your entire, portfolio if you were to own individual stocks with single shares, right? But the idea now is to find out what would happen if the interest rates were to increase by 0.25%, right? So what I'm going to do is I will actually write a new earnings yield right here. And in fact, maybe I should just increase this a little bit. And I will get this earnings yield and I will increase it by 0.25%. So that's your 3.01%. So what happens is, if Fed were to increase interest rates, it actually would go into the market as a shift in interest rates for all the assets in the investment spectrum. The least risky asset, the US Treasuries, the Fed window, the US Treasuries, if they were to increase in yield about 0.25%, then every asset that has risk above and beyond the US Treasuries will have at least an increase of 0.25% and then some. So our investments here are stocks. So it's just natural to expect that the 0.25% increase in the interest rates will be reflected on the expectations of stock prices, and there will be probably some more because that also is a riskier asset, and then therefore the shock to the price is expected to be a little bit more. But we'll assume that it's only 0.25% and it affects everybody evenly, and we'll go from there. Now, with the 0.25% increase in interest rates, the earnings yield is expected or assumed that it will also increase about 0.25%. That makes this to be 3.01. So the idea really is what stock price would make the earnings yield 3.01% instead of 2.76%. Because before the interest rate increase, everybody was paying $118.69 for an expected earnings of $3.28 per share. That makes the yield to be equal to 2.76%. Now, if interest rates in the economy are increased altogether by 0.25%, then as an investor, it is natural to assume that I want to earn this 3.01 from this individual investment, and therefore I would pay for this stock according to that expectation, which means that earnings per share does not change. It's what we expect it to begin with. But then if I'm earning 3.28% and I need to earn, if I'm earning $3.28 and I need to earn 3.01%, then what do I need to pay for this stock, given the earnings per share doesn't change? And given that I need to earn 3.01%, that's a 0.25% increase in the overall interest rates, then what stock price do I need to pay for this? Then I will just reverse my calculation, because remember, when we calculated the earnings to price, we simply took the earnings per share and divided it by stock price. But now, what I'm going to do is I'm going to reverse that. I'm going to take earnings per share and divide it by the expected, or what we needed to be, earnings yield, which means that the stock price, if I were to pay $108.84 for the future earnings of $3.28 per share, then my yield would be 3.01%, right? So let's try that. What I'm going to do is immediately, and remember, we are at, in fact, maybe I should just type this right here, old value, or before the interest rate change value. Let's keep it old value. So that's $98,961.85. Now notice this is going to change because I'm changing the stock price. So I'm just going to type it in, the new price that I'm willing to pay for this, and watch right here, right? The 2.76. And now, right? So we actually made it to 3.01, right? So now I will just do this like this, right? Old value, just so that we have some reference as to what is happening. And that's at 2.76%. And what it needs to be is 3.01. So now that we did this little calculation right here, we know the price has to be 108.84, and that actually makes it to a 3.01%, which is 0.25% increase than before. So we've done that for Apple. So let's do the same for Bank of America. What I'm going to do again is I will take, well, first of all, let's type in the old value, 8.35%. Now I need this to increase by 0.25%. So then I need a number. Well, first of all, earnings per share doesn't change. Our expectation of it doesn't change. And given that, I need a new stock price that would make the earnings yield to be 8.60%, given the earnings per share of $2.03. So then I'll take the earnings per share and divide it by the 860, which gives me 2360. So let's type that in, 2360. And yes, we have achieved the 860. And again, notice how the old value is 835 And then the new value is 860, which is 0.25% increase than before. And then we do the same for AT&T. So we need to increase the yield by 0.25%, and earnings per share doesn't change. And I want to type in the old value right here. What price would make the yield to be 583, given the earnings per share is $1.53, which is 26.26. Now notice I'm going to change this, and the earnings yield will change to 583. Right. So let's erase this, and then that's it. Now let's do the same for Exxon. We need to increase this by 0.25%. The earnings per share doesn't change. What price would make the yield to be 238%, given the earnings per share expectation of 78 cents? So that divided by the new yield, that's 29.66. And we have that. So these two are also done. Let's do JP Morgan Chase. So it's a 745 is the original yield, and we need this to increase by 0.25%, and then we expect the earnings per share to stay the same. And what price would make our yield to be 7.7, given the earnings per share expectation of $7.67, and that's 99.62. And finally, we'll do Walmart. So the Walmart is 433. That's the earnings yield. We're going to increase that by 0.25%. So let's write the old number right here. And our earnings per share expectation doesn't change. What price would make our yield to be 458, given the earnings per share expectation of 631? And that's 137.81. 137.81. Right? So that actually is pretty much it. So what happened is we had a old value that's before the interest rate change, 98,961, and our total actually went down to $93,425. So an interest rate increase of 0.25% had an impact of about $5,500. And similarly, if the interest rates were to drop, your portfolio value should be or would be expected to increase. And really, it is based on the earnings yield theory. Just as any other investment security, stocks are priced based on how much yield you expect to earn as an investor. So if you are hoping to earn about 3%, then you price your earnings per share based on that expectation and pay $108. Now, if you are looking to earn more, then you will pay less for the stock for the same amount of earnings. So the way to increase your yield is to pay less for it. If you cannot change the earnings per share, which as an investor you have no control over it, then the only way that you could increase your yield is to pay or buy the stock at a cheaper value, so pay less. So that would, the interest rate increase then would have a lowering impact on your portfolio. An interest rate decrease would increase the value of your portfolio. And in fact, if you look at the S&P 500, going back, say, 5 years or so, or perhaps a bit more, the 2007 financial crisis right here was so severe that the Fed started to fund the market through a very low interest rate, sometimes as low as 0. And that actually led to a very bullish market simply because of what we just talked here. If the earnings expectation is zero or very close to zero, then the price that you pay for these assets, for these securities, will be very, very high. So the lower yield means competition. And in order to buy this asset, there will be a competition, and therefore the prices of these stocks will go up. And in fact, during this time, the Fed started what's called a quantitative easing, which, in order to increase the money in the economy, they simply bought back U.S. Treasuries and left cash in the market, and that cash simply flooded the market, the securities market, which you would have expected inflationary effect, but I guess U.S. is still a safe haven for the world during these hard times, and that actually led to more competition in the market, and therefore prices were just ever increasing. So, having said that, that pretty much wraps up our discussion for this question. Our question was that what would be the expected change in your portfolio value if Fed were to increase interest rates by 0.25%? And this would be your answer. So that's about it. Thank you for watching, and please let me know if you have any questions. Thank you.